Welcome back to the Monetary Metals YouTube channel. My name is Erik Oswald and I'm a Relationship Manager here at Monetary Metals. If you like what you are about to hear, be sure to visit our website where you can contact me personally at www.monetary-metals.com. Here is my latest blog post titled, "Can Interest on Gold Outpace Inflation?" Yield. It's on the tip of every investor's tongue, but it's much harder to find than it used to be. In the long ago era of the early 1980s, one could simply open a savings account, purchase a CD or a US 10-year Treasury note, and earn between 7 and 14% interest. The idea of earning 14% on government debt seems the stuff dreams are made of. Interest rates are at zero, near zero, or negative across much of the developed world. One of the many problems with falling interest rates is that it becomes near impossible to outpace inflation with your capital. This question becomes all the more relevant in light of the recent bout of transitory inflation we are facing. How can you generate a yield that will beat inflation? We'll revisit that question in a bit. First, we need to talk about that four-letter word, gold. Gold. To yield or not to yield? As interest rates continue to hover near historic lows, many investors sense something amiss in the monetary system today. Many have turned to gold as an answer. They view gold as a safe haven asset, protecting them from falling rates and currency debasement. While gold can be a means to protect your capital, others view it as nothing but a shiny, dead lump of metal. A game you only win through buying low and selling higher to net more dollars than you started with. Warren Buffett epitomizes this viewpoint, and yet a growing minority view gold as real money and dollars as something else. For much of the last century, buying gold worked as Warren Buffett described. You pay people to dig it out of the ground, only to pay others to put it back in the ground and stand guard. Gold did nothing productive and offered no yield, though its price in dollars rose considerably. The reemergence of gold interest rates. In 2016, something changed. Gold offered a yield again. We say again because back when gold was legal money, it had always offered a yield. Only when it was banished from the monetary system did interest on gold dry up. Since Monetary Metals started paying interest on gold again, one-year gold leases have generated yields between 2 to 4.5% per year paid in gold, and silver too. A yield on gold to outpace inflation. Let's revisit our question from before. How to outpace inflation? With CPI touching 5.4% in July of this year, some might look at a rate of 2 to 4.5% interest on gold or silver and say, neat concept, but aren't I still losing my principal to inflation? This is the classic error of comparing apples to oranges. Is a 2% interest rate on gold the same as a 2% interest rate on dollars? We think not. A little history lesson to explain what we mean. Inflation erodes yield purchasing power. In 1970, the average price of an ounce of gold was approximately $36 per ounce, and the yellow metal was still intrinsically linked to the value of the US dollar. The median home price was $17,000, while the median household income was $9,870. Priced in gold, the average cost of a home was 472.22 ounces of gold, and the average household income was 246.16 ounces of gold. Consider that for a moment. In 1970, assuming no expenses, many families in America could purchase a home with savings amounting to just 2 years of the average household income. Fast forward to 2020. Last year, the average price of an ounce of gold was $1,770, but no longer was gold linked to the paper notes that we call money. Median home prices in 2020 were $358,700, while the median home price was $67,521. Priced in gold at $1,770 per ounce, the average home price in 2020 was 202.65 ounces of gold, and the average household income was 38.14 ounces of gold. Priced in gold, home prices have fallen more than half. That's great, until you realize that household incomes have fallen 86% over the last 50 years when priced in gold. Wow. That's what happens when you take the money, gold, out of money, dollars. A yield on gold to the rescue. To paraphrase JP Morgan's famous quote, gold is money and everything else, including dollars, are credit. Over the millennia, an ounce of gold has always remained an ounce, while over just 2 centuries, the dollar has been twisted, distorted, and tortured so many times that it is a mere shadow of what it once was, i.e. a note redeemable in a specific weight of gold. Put it this way, would you rather earn a 2% yield denominated in gold or 2% in a piece of paper that has been perennially losing its value year after year, decade after decade? The choice is yours. That concludes the audio version of my latest blog post, Can Interest on Gold Outpace Inflation? Make sure to subscribe to the channel now, and if you like what you heard from me and want to get started, make sure to go to our website, monetary-metals.com, to get in contact with a relationship manager today. See you next time.